and Brian Walker, president of the AFI Group. And welcome, gentlemen, to this week's topic, which is income strategies for retirement income planning. So we just wanted to start off today. It's a popular topic, and people are always interested in learning kind of the best retirement income strategies. There seems to be a lot of debate about which direction to go. And so today we're just going to start off with a few questions, and I'm going to direct the first one towards Edward. And the first question that we have from viewers is, what would you recommend for a guaranteed retirement income?
Thanks, Robert. So in this business, there are not really that many options that we have that we can throw the word guaranteed and have that associated with that strategy. One such option is what is called an annuity. And a lot of people may have heard that term before, but don't necessarily know exactly what that is or what that means. Now, there are plenty of different annuities that are out there, and I'm not going to spend the entire 20 minutes or so getting into every facet of various different types of annuity, but I'll go into some of the general characteristics. So basically an annuity is like funding your own pension. So you can either put in a lump sum or put in over a number of years, but the guarantees that it offers you are a couple of things. One, with market volatility being at the forefront over the last few months and the wild swings in the market, it guarantees no loss of principal. What does that mean? Well, you have annuities that may pay a fixed interest rate of maybe 2-3%, or it can track an index, for example, the S&P 500. Now, if the S&P 500 is negative, within that annuity, you get credited 0%. Now, if the S&P is up 10%, 15%, 20%, whatever the case may be, there are a couple ways that you can get interest credited. It won't be that full amount, but it would likely average somewhere around 4, 5, 6% over the long term. The other guarantee that it offers you is, the reason we're talking about it right now, is it offers you a stream of guaranteed income for the rest of your life. So as you accrue and amass this wealth within an annuity, at some point you decide to turn on that income stream, which is called the annuitization period. When you do that, there's a percentage rate that the insurance company will pay you for the rest of your life. So even if those funds that have grown are completely exhausted, you still receive guaranteed income. Now, what are the pros? The pros are exactly some of the things I talked about. No loss of principal, guaranteed income. What is the real main con of an annuity? Well, the main one is we don't really have really high return potential. But for most people, they really love to have the peace of mind to know that, hey, a portion of the income that I get is never going to go away, no matter how long I live for the rest of my life. So that's one form of guaranteed income.
And Brian, in regards to annuities, how do you feel about annuities in regards to taxation in retirement? What are the implications in regards to taxes?
Yeah, thanks, Robert. Great to be here with you guys again. And, annuities are interesting. Like Eddie said, you get the guaranteed income stream, which is great. And we feel that every portfolio should have some form of guaranteed income stream, but that income stream can be taxed. And it really depends on how that annuity is structured. Is it possible for your annuity to not be taxed? And the answer is yes. Is it possible for that money to be 100% taxable when it's coming out to you in retirement? And the answer is yes. So you really want to look at the big picture as far as your portfolio goes to determine whether or not your annuity will be structured as a Roth annuity, which means it grows tax-free and comes out tax-free, or a taxable annuity, which means the gains are taxed and the distributions would be taxed in that case. So you have some options, but in order to truly plan correctly, you have to incorporate the entire portfolio.
Edward, I wanted to ask the next question, really, which is about Social Security. We know that almost half of Americans rely on Social Security. They don't want to outlive their assets, and Social Security allows them to do that. So if they're so reliant on Social Security, how do we maximize Social Security?
Yeah, that's a great question, Robert. And realistically, for most Americans, Social Security is going to be a massive benefit over the course of an entire retirement. And a lot of people don't realize that the IRS wants to tax your Social Security. That comes to news to a lot of people when we're teaching classes, giving webinars. They didn't realize that it was potentially taxable, and there are some rules associated with that. Most people don't know that. I mean, it feels like a tax when it comes out of our paycheck, so why would they tax us on it when they actually give us that benefit? But there is a little thing called provisional income that we talk about in more detail in a lot of the classes, and that's what the IRS uses to track whether or not our Social Security is taxed. I'm not going to get into great detail about those rules, but there are ways that you can implement strategies with your other assets in order to ensure that that provisional income number falls below the thresholds so that you can get your Social Security tax-free. And what we found, I mean, we run these numbers on a daily basis, hundreds of times a year, and what we found is that those individuals who are able to get their Social Security tax-free can grow their assets and don't have to rely on all of their other assets, and their money lasts anywhere from 6 to 10 years longer in retirement. Either that, or at the end, when we graduate from this planet, what happens is we have substantially more assets to pass on to our children, to our grandchildren, to the charities that we want to support, to those things that we believe in, to the legacy that we want to leave behind us. So it's very impactful to be able to implement these strategies to try to get our Social Security tax-free. Now, not everyone can do that. There are a number of people that have pensions, but by positioning all of the other assets to help create income that we may need that doesn't increase our taxes can make a huge impact for those who receive pensions.
Yeah, Brian, and I know that you teach taxes in retirement, and one of your main strategies that you are so proficient at teaching people to maximize is really transitioning assets into tax-free investments. You mentioned Roth annuity, which can you kind of explain the motivation for why it's so important to transfer assets now in order to protect Social Security taxation in the future?
Yeah, I just wanted to touch on one of the things about Social Security that Eddie was talking about. It is very, very beneficial and important, in my opinion, to learn how to receive your Social Security tax-free. If you can eliminate that taxation, like Eddie said, 6 to 10 years longer is how long your assets will last. Now, most people, when they're planning for retirement, they're working and they don't have the time to implement the strategies that we're talking about on a daily basis. And there is so much that goes into getting your Social Security tax-free that you really need to understand all the ins and the outs of all your other investments and all the other options that are out there. So it is a complex formula. It's not something that one day you just wake up and say, hey, I figured out how to get my Social Security tax free. So boom, I'm going to flip the switch and now I get it tax free. Unfortunately, it does not work that way. So, Robert, to answer your question about taxes, well, right now is the perfect time to start planning the ability to get your Social Security tax free. And the reason for that is tax rates are low. They're at historical lows, as a matter of fact. And we see our country spending money like crazy right now. Already this year, and we're halfway through the year, we're already at a deficit of over $3 trillion for the year. So that's just adding on top of our debt. And our government, at some point, to answer all of that spending, is going to have to raise taxes. They have to bring in more revenue to be able to pay down and service the debt that they've accumulated over decades. So what is the easiest way for them to take care of that debt? Raise taxes. Pretty simple. So if you wait 10 years from now and start to do the shifting from your tax deferred taxable accounts into tax free, it's probably going to be too late. You've also potentially lost the ability to receive your Social Security tax free as well. Because like I said, it doesn't just happen by chance that you receive your Social Security tax free. It requires a lot of planning and a lot of implementing a plan year over year. For some people, it could be for 10, 20 years. For other people, it could be as little as 4 or 5 years. So it really depends on where you are in your retirement plan. Are you accumulating for retirement? Are you trying to preserve your money for retirement, or are you in retirement? And you can still do this if you're in retirement. So there are a lot of options out there, but bottom line, you have to understand all of your assets, your entire portfolio, how they are affected by taxes, and then also how they affect taxation on your Social Security. And if you can successfully do that, you have the ability to have a tax-free retirement. And I will just finish with this, and I've probably hit this a couple of times already on this video, but when you're planning for retirement right now, plan for taxes to be higher in the future. If you plan for that and your expectations are that taxes will be higher, then you'll be ready for that. And if they don't go as high as you thought, then you're better off.
Well, you know, Brian, just to jump in also is that's been a little bit of a recurring theme over the course of this video. But what people may still not realize is that there comes a date where taxes are guaranteed to go up. And it's actually a combination. It's January 2026. The current tax reform will expire. So Congress can do absolutely nothing at all. They're pretty good at doing that, by the way. And tax rates will go up. Not only do those tax rates go up, but even more impactful than that, the income thresholds will come down. So we have kind of a little bit of a double whammy, right? We have tax rates going up, income thresholds coming down. But I know that we've all done the math, and we know that even at those rates, tax rates are likely to have to increase to sustain the spending that we've been going through.
Well, I'd like to thank you both for joining us today. I know this is a very broad topic, and we're covered a lot of ground in a very short period of time. But if you'd like to learn more about any one of the strategies that was discussed today, please check out the links below. And Also, you can subscribe to our channel so that you can be notified every time a new video comes out. We encourage you to join us for any one of our webinars or live events, whatever's your preference. And you can always do that by going to theafigroup.com/events, and you can get a more comprehensive view at any one of the strategies that both Brian and Eddie introduced today. We thank you for joining us. We hope that you join us again in the future. Feel free to like and comment, and we hope to see you next week.